Ever wondered how the wealthiest investors keep getting richer? The secret is dividend investing, and today I'm going to show you how you can do it too. If you're new to the world of investing or simply looking to build a steady stream of passive income, you're in the right place. In this video, I'll walk you through everything you need to know about dividend investing, from understanding what dividend stocks are to building a profitable dividend portfolio. I'll show you how you can start with only a $50 weekly investment plan. And in the end, I'll present a portfolio of stocks that has the potential to grow from the $50 weekly investment plan to an over $3 million valuation, paying you over $30,000 in monthly dividends. Alright, let's dive right into the core of dividend investing. First, let's break down what dividend investing actually is. Simply put, dividend investing involves purchasing shares of companies that pay dividends. These are regular payouts to shareholders from the company's profits. Think of it as a reward for your investment, much like interest on a savings account, but with often much higher returns. Here's how it goes. You buy shares of a company, and every quarter they send you a portion of their profits. This is your dividend. It's money in your pocket without having to sell any shares. It's like having a rental property that pays you rent every month, but without the headaches of being a landlord. So how do dividends work? Let's take an example. Suppose you buy 100 shares of a company at $50 each, and the company pays an annual dividend of $2 per share. This means you'll earn $200 in dividends every year. Over time, these dividends can add up, especially if you reinvest them to buy more shares. This process, known as compounding, can significantly boost your returns in the long run. Now, you might be wondering why a company would pay dividends instead of reinvesting all their profits back into the business. Great question. Companies that pay dividends are often well-established with stable cash flows and fewer growth opportunities. They choose to return a portion of their profits to shareholders as a way of sharing their success and rewarding investors for their trust. There are several benefits to dividend investing. First and foremost, it provides a steady income stream, which can be particularly appealing if you're looking for passive income. Unlike capital gains, which require you to sell your stocks to realize a profit, dividends give you regular payouts without needing to touch your principal investment. Another advantage is the potential for compounding. By reinvesting your dividends, you can buy more shares, which in turn earn more dividends. Over time, this snowball effect can lead to substantial growth in your investment portfolio. This is why many successful investors, including Warren Buffett, emphasize the importance of dividends. Buffett once said, "The best investment you can make is in yourself. The more you learn, the more you earn." And learning about dividend investing is a great way to earn more over time. Dividends also provide a cushion during market downturns. Even if the stock price drops, as long as the company continues to pay dividends, you'll still receive income. This can help mitigate losses and provide financial stability during volatile market conditions. Furthermore, companies that consistently pay and increase dividends are often financially healthy and well-managed. These companies tend to have strong cash flows, solid balance sheets, and a commitment to returning value to shareholders. Investing in such companies can add a layer of safety to your investment portfolio. It's also worth noting that dividend income is typically more predictable than capital gains. While stock prices can fluctuate significantly, dividend payments are often more stable, providing a reliable income stream that can be especially valuable during retirement or economic downturns. Now that you know what dividends are and why it's worth it, the next step is setting investment goals. It's crucial to set clear investment goals and understand your risk tolerance. Having well-defined goals will guide your investment strategy and help you stay focused even when the market gets turbulent. Let's break down how to set your investment goals and understand your risk tolerance. First, ask yourself, what do you want to achieve with your investments? Are you looking for a steady income stream, capital growth, or perhaps both? Setting specific, measurable, achievable, relevant, and time-bound goals, SMART, is a great way to start. For example, you might aim to generate $1,000 in annual dividend income within 5 years, or grow your portfolio to $50,000 in 10 years. Remember, in the end, I'll show you a portfolio of stocks that can achieve that, and over the long run, potentially reach an over $3 million valuation, paying over $30,000 in monthly dividends. Back to SMART goals. Consider your risk tolerance, which influences your investment choices. Conservative investors prefer stable, low-risk dividend stocks, while aggressive investors might opt for higher-risk stocks with greater returns. Diversify your investments across sectors like healthcare, consumer goods, and utilities to reduce risk. This minimizes the impact of a downturn in any one sector and enhances steady returns. Align your investment goals with your time horizon. Long-term investors can take more risks and benefit from compounding, while short-term goals require a conservative approach to prioritize capital preservation. For this video, our goal is to invest $50 every week into a portfolio and retire with a solid fund that consistently pays monthly dividend income. Okay, now that we've set our investment goals and understand our risk tolerance, let's explore different dividend investing strategies. When it comes to strategies in dividend investing, you have the option to think long-term or short-term. Short-term dividend investing focuses on generating immediate income rather than long-term growth. This strategy might involve buying high-yield stocks to earn substantial dividend payouts in the near term. It can be particularly useful if you need to generate cash flow quickly. However, high-yield stocks often come with higher risks. The yield might be high because the stock price has dropped significantly due to underlying business issues. Therefore, it's crucial to thoroughly research these companies before investing. Let's look at an example. Suppose you invest $10,000 in a stock with a high annual dividend yield of 10%. In the first year, you'll earn $1,000 in dividends. While this provides a substantial immediate return, it's essential to assess the sustainability of such high yields. High yields can be a red flag indicating financial distress or an unsustainable payout ratio. If the company maintains its dividend, you'll earn $1,000 annually, but remember, the sustainability of such high yields should be carefully evaluated to avoid potential pitfalls. Long-term dividend investing is all about patience and consistency. The goal here is to build a portfolio of high-quality dividend-paying stocks and hold them for many years, allowing dividends to compound over time. This strategy leverages the power of compounding to grow your investment exponentially. Let's consider another simple example. Suppose you invest $10,000 in a diversified portfolio of dividend stocks with an average annual dividend yield of 4%. If you reinvest the dividends, your investment will grow significantly over time. After the first year, you'll earn $400 in dividends, 4% of $10,000. If you reinvest these dividends, your total investment grows to $10,400. The following year, you'll earn 4% on $10,400, which equals $416 in dividends. This process continues with your dividends earning more dividends, leading to exponential growth. After 20 years, your initial $10,000 investment could grow to over $22,000, assuming a consistent 4% yield and reinvestment of dividends. The key to this strategy is selecting companies with a strong history of paying and increasing dividends. Look for companies with a track record of consistent payouts, solid financials, and a commitment to returning value to shareholders. These are often found among dividend aristocrats or dividend kings, companies that have increased their dividends for at least 25 or 50 consecutive years. You see, dividend growth investing combines the benefits of long-term investing with a focus on companies that regularly increase their dividend payouts. The goal is to invest in companies with a history of dividend growth, which can provide both income and capital appreciation over time. For example, you might invest in a company that currently pays a modest dividend yield of 2%, but has a track record of increasing its dividend by 10% annually. Over time, the growing dividend can lead to significant income. If the initial yield is 2% and the company increases its dividend by 10% each year, after 10 years, the yield on your original investment could effectively be 5.2%. Here's how it works. If you invest $10,000, you'll earn $200 in dividends in the first year, 2% of $10,000. With a 10% annual increase, the dividend in the second year will be $220, the third year $242, and so on. After 10 years, your annual dividend income would be approximately $520, more than doubling the initial yield. Dividend reinvestment plans, or DRIPs for short, are an excellent way to take advantage of the power of compounding. DRIPs allow you to automatically reinvest your dividends to purchase additional shares of the company, often without paying any commission fees. This strategy can accelerate your portfolio growth by continuously buying more shares with the dividends you receive. For example, if you own 100 shares of a company and receive $200 in dividends, a DRIP would automatically reinvest that $200 to buy more shares. Over time, this results in owning more shares and receiving more dividends, creating a snowball effect. In the end, I'll show you how this DRIP strategy can make a difference of over $2 million, reaching over $3 million in valuation and paying over $30,000 in monthly income. Now that you understand the various strategies for dividend investing, it's time to learn how to find the best dividend-paying stocks. To find great dividend-paying stocks, look for companies with a strong track record of paying and increasing dividends. Companies that consistently pay dividends even during economic downturns are financially stable and well-managed. Focus on dividend aristocrats and dividend kings, S&P 500 companies that have increased dividends for at least 25 or 50 consecutive years, respectively. After finding stable stocks, you need consistent paying stocks. Utility companies, consumer staples, and REITs are top picks for reliable dividends due to their stable cash flows and lower sensitivity to economic cycles. Key metrics to consider include the dividend yield, which tells you the income relative to the stock's price. While high yields are attractive, ensure that they're sustainable to avoid trouble. Next, consider the payout ratio, which is the percentage of earnings paid out as dividends. This ratio helps you understand how much of the company's profits are being returned to shareholders. A lower payout ratio suggests that the company has room to increase dividends in the future and is also retaining enough earnings to invest in growth. Generally, a payout ratio below 60% is considered healthy. The dividend growth rate measures how much the company's dividends grow annually, so look for companies with at least 5% annual increases. By the way, you can find all this info in a one-stop trade app called Moomoo, today's video sponsor. Moomoo is an app that allows you to trade stocks, options, and ETFs from your laptop, iPad, or your phone. And they don't charge any commission fees, unlike some other brokerages that do. It offers powerful free features like financial analysis, market monitoring tools, forecasting, and conditional orders, helping you spot bullish stocks and potential investment opportunities. New users can earn up to 8.1% APY on idle funds for 3 months and enjoy a generous welcome bonus, including up to 15 free stocks and a 1.5% cash reward up to a $300 maximum on initial transfers. Sign up using my link in the description, make a deposit, and take advantage of these amazing rewards. Don't miss out on this opportunity to enhance your trading experience with Moomoo. All right, now that you know how to find the best dividend-paying stocks, let's create a well-diversified dividend portfolio. First, I'll start with selecting 3 of the best dividend aristocrats or kings for my portfolio. Some excellent long-term investment stocks are Abbott Laboratories, AbbVie, Target Corporation, NextEra Energy Incorporated, and Atmos Energy Corporation. Studying the investments of big players like Vanguard, BlackRock, and JP Morgan can also provide valuable insights. But for me, recently, these 3 aristocrats have taken the top spots. They include KB Home, Cintas Corporation, and Lennar Corporation. Next, I'll choose 2 REITs. Why real estate investment trusts? Because REITs are required to pay 90% of their earnings to their shareholders, ensuring my portfolio will keep paying even during struggling times. 2 solid REITs include American Tower Corporation and CubeSmart. To combine it all, I'll be adding the ProShares S&P 500 Dividend Aristocrats ETF, known by the ticker symbol NOBLE. This ETF focuses on S&P 500 companies that have increased dividends for at least 25 consecutive years. The reason for including this ETF is so that I don't miss better opportunities and don't have to actively manage my portfolio on a regular basis. Here are the investing metrics of each of the selected stocks. So, if I were to create a portfolio of my selected 6 stocks, it would have an average dividend yield of 2.2%, a dividend growth rate of 20.45%, and an annual value appreciation of 13.89%. You can simply calculate that by adding the respective metrics and dividing by 6 for each of the metrics. Okay, so now let's look into the future projection of this portfolio. If John contributes $50 weekly, which amounts to $200 monthly or $2,400 annually to this portfolio, here's how it boils down. After 10 years, with continuous contributions and the effects of compounding, this portfolio could grow to about $54,121. This growth combines your regular contributions, dividend reinvestments, and the appreciation in share prices. After 20 years, the power of compounding becomes more evident, and John's portfolio could reach approximately $383,891. After 30 years, it has the potential to grow to an impressive $3,511,886. By this time, the dividends themselves would be contributing significantly to the growth of your portfolio. In fact, after 30 years, the annual dividends from your portfolio could amount to $381,453, which translates to a monthly dividend income of $31,788. Breaking down these projections further, over 30 years, the total value added to your portfolio would be approximately $3,439,886. Out of the total value added, $1,916,162 would come from the appreciation in share prices of your dividend-paying stocks, while the remaining $1,523,724 would be the result of reinvested dividends. Want to know about 52-week low stocks that have the potential to pay upwards of $60,000 in monthly dividends? Click the video on the screen to find out.